I'm coming to you from the foreign land of academia, where the gold standard is considered a sort of out-to-lunch idea, and it's kind of a puzzle given the track record that the gold standard has. A couple of years ago, a survey of economists at top schools, Harvard, Yale, Stanford, MIT, Berkeley, Chicago, Princeton, who are surveyed by something at the University of Chicago Business School called the IGM Forum. They were asked to comment on the following proposition, that if the U.S. replaced its discretionary monetary system with a gold standard, the outcomes would be better for the average American. And here were the responses. 40% disagreed, 53% strongly disagreed. The others didn't answer. There was nobody who was uncertain, who agreed, or who strongly agreed. This is out of 40-some respondents. And they were, the respondents were invited to make their own comments in writing on the question. And my favorite came from Austin Goolsbee, who is back at the University of Chicago after having worked for the administration, who checked the strongly disagree box. And his comment was simply, "Eesh, has it come to this, that we have to discuss the gold standard?" Right? It's so far beyond the pale in his view. But it's perplexing because, as Nathan just showed you in amazing detail, and by the way, I think for the second edition of your book, you ought to make the charts in color, like the slides, because they really pop out that way. To say things in favor of the gold standard is sort of to put yourself outside the club. And if you're outside the club, the expression you sometimes hear is, well, you seem to have faith in the gold standard. But I don't have faith in the gold standard, and Nathan doesn't have faith in the gold standard. We have evidence. We have evidence that the gold standard works. And Nathan's book is a good presentation of that evidence. He starts out with the question of what is a gold standard. Nathan mentioned to me earlier, before we went on, that he had seen my book, The Theory of Monetary Institutions. And there, the definition I give, the most generic definition of a gold standard, is that a gold standard is when money is meaningfully denominated in units of gold, which means two things. Money is the medium of account. It's the stuff in terms of which prices are posted and computed. So some unit of gold is the unit of account, right? The thing you see on price tags. And in much of US history, the dollar was just a name for so many ounces of gold. But there's a second thing that makes the meaningful part of it, which is that gold-denominated pieces of money, if they're made of paper, say, or if they're bank account balances, they're redeemable for gold. Gold is the medium of redemption. You can go to the bank and get gold back for your bank liabilities. Nathan is a little less strict than that. So you invite an academic, you're going to get quibbles. Here's my quibble. He doesn't insist that gold has to be the medium of redemption in order for you to call it a gold standard. He defines a gold standard as a system with a precise policy goal of fixing the ratio of dollars to ounces of gold, or whatever the unit of account name is, to ounces of gold. My view is that a gold standard doesn't need to have a policy maker, and so it doesn't need to have a policy goal, right? It's a spontaneous order that emerges from the market. If there's a ratio that's being aimed at, but the way it's being aimed at is by the central bank targeting the market price of gold, I wouldn't call that a gold standard. I would call that a fiat standard with a gold price target. And I think there's an important difference in the sort of level of commitment that that kind of system would involve. So historically, I mean, where the historical payoff is the question of whether the Bretton Woods system counts as a gold standard. Well, for US citizens, no. I mean, US citizens could not redeem their dollars for gold. They were, in fact, forbidden up till '74 from owning gold in physical form, in monetary form. European central banks, all the banks that were signatories to Bretton Woods, they could redeem their dollars for gold at $35 an ounce, except not quite freely. The U.S. pressured them not to redeem when the U.S. Treasury started running out of gold. And sometime in the 1960s, basically, the Federal Reserve System stopped being constrained by its gold reserve position. And I would date that occurrence basically when Keynesians took over the Council of Economic Advisors in the Kennedy administration. So I'm not sure the Bretton Woods system, at least in the 60s, counts as a gold standard. It wasn't really constrained by the rules of the game. Two things we do agree about strongly that you saw in one of Nathan's slides is a gold standard doesn't require a central bank. It's not a set of instructions for a central bank. It's a constraint on a central bank if you have a central bank on the gold standard. And secondly, it doesn't require 100% reserves for gold-denominated bank accounts. I think Nathan did a good job of today and in the book of emphasizing the main benefits, the main merits of a gold standard by contrast to fiat standards. Lower average inflation rate, lower average expected inflation rate. That means it's less costly for people to hold money. It means it's less costly for people to save in the form of money. Those are both very important for economic performance. Secondly, there's less uncertainty about the price level 5 or 10 or 20 or 30 years down the road. In a paper that I was a co-author of, published in 2012, my co-authors and I, mostly the guy who does the time series econometrics, tried to provide some actual estimates of the difference in price level uncertainty between the gold standard period and the post-gold standard period in the US, and it's quite dramatic. You have much less danger of being way off in your guess about what the dollar is going to be worth 30 years from now under the gold standard than you do today. And so the symptom of that is long-term bond markets, at least for corporate bonds, have pretty much dried up. And there's only a market for 30-year Treasury bonds because the Federal Reserve buys so many of them. And there's a kind of an irony to the greater price level uncertainty, which is individuals who want to have a hedge against inflation buy gold and hoard coins and bullion. And as a result of that, the real price of gold has actually gone up since we left the gold standard. Central banks have stopped accumulating gold. They haven't sold much. But private individuals have accumulated a lot of gold for very understandable reasons. But the irony here is that one of the benefits of leaving the gold standard, Milton Friedman told us, was we could free up all this gold. We wouldn't bear the costs of digging gold out of the ground and burying it in vaults. Well, we don't bury it in central bank vaults anymore, but we bury it in all kinds of other vaults. So we haven't saved that resource cost. So it would actually be cheaper to go back on a gold standard in terms of the amount of resources devoted to gold mining. Third benefit, global network currency benefits. As Nathan said today, it's much easier to trade and invest across borders when you don't have to worry about exchange rate fluctuations. The other country devaluing their currency, and you have wages to pay in that currency, or you have IOUs denominated in that currency. So you get more gains from cross-border trade and investment, and the classical gold standard was the first period of international globalization. Fourth thing, which wasn't much mentioned today, fiscal discipline. It's harder to borrow money if you have to repay it in gold because governments can't create gold out of thin air.